Good morning. All right. Uh, Hitting our final stretch here. We're moving on to a couple different topics now, getting into some new areas. So one of the things we're going to be seeing with the tax changes for 2019, we'll be talking about today. So one of the biggest, hopefully, presents you'll get for the season, at least early here, will be what we'll be talking about with the Affordable Care Act and how that's going to be impacting our tax returns for the 2019 year. So do want to kind of talk about a couple things today. We're going to be talking about a couple different issues, state taxes, the Affordable Care Act, but we also wanted to talk a little bit about some unique filing situations. So here in Lancaster County, we actually have a fairly good amount of refugees coming into the area through various programs, and just want to talk a little bit about what those filing status opportunities could be. Now, this will be an advanced topic, so if you are going for advanced certification, it would allow you to go ahead and work with individuals that have immigrated here to the U.S. If you're looking for basic certification, feel free to enjoy your snack for another 5 to 7 minutes as we talk about kind of the filing status issues here. One of the things we take a look at is people are now moving into the country. We have to determine residency status. Would they be considered a U.S. resident, or would they be a non-resident? And we do have some guidelines within your 4012 to help you go through that decision process. Once we determine residency status, whether they're a non-resident or resident alien, that will help determine what they're eligible for in terms of filing status, credits, deductions, that type of thing. If we do have individuals here on a specific visa, generally kind of certain work visas, student visas, they're unfortunately out of scope for VITA. So if generally that'll be kind of gone through the process with 211, or the greeter will make sure that we don't have anyone coming in with a visa on a code, an F, a J, an M, or a Q. These are going to be outside the scope of VITA in all circumstances. Now, one thing we do want to take a look at is if we do have resident aliens, and these are individuals who are here legally in the US, and they are not citizens yet, but they are legally resident within the US, they're going to be treated similarly to US taxpayers. So a U.S. resident is going to be bound by the same rules and filing requirements as other individuals would be. We're going to be taking a look at the same filing decision trees that we had before, same dependency rules. They will be taxed on worldwide income. Now, don't worry about that too much, because really most of the people we have coming in do not have any income outside of the U.S. Typically, if they're coming here to Lancaster County, they're coming through a refugee program, meaning that they have probably come from another country through a refugee camp program. So typically we don't have any additional worldwide income. Now, if they're a non-resident alien, so basically they're not meeting the qualifications for residency, which I'll talk about in just a minute, then they would have to file a Form 1040-NR, which, if you can guess what the NR stands for, it's for non-resident. That is outside the scope of VITA. TaxSlayer does not handle that form very well. A lot of more complexities involved with that. So typically where we may see these are going to be some students, perhaps people coming in from outside on a guest teaching visa. They could be undocumented immigrants. Unfortunately, we cannot handle those returns, and they'll have to go outside to have those returns prepared. Sometimes if you have students coming in who are here on a student visa, oftentimes the college or university may have some resources available for them in order to have their returns filed. We unfortunately cannot do that here at VITA. Now, when we take a look at the resident alien tests, we actually have a fairly decent section within your 4012. Your tab L really covers a lot of the resident versus non-resident issues. First thing we take a look at would be whether or not the individual has a green card. Just to warn you, this card is no longer green. So if you're looking for a green document, it is no longer green. However, they kept the name. It's basically a valid alien registration card. So they've gone through the process, they've been registered, and they are lawfully present here in the US. So it basically gives them rights and privileges to be here in the US. If they have a green card, they are a they're a resident alien subject to US taxation. So we can go ahead and prepare a return as if they were a US citizen. One of the other things we can take a look at is what we call the substantial presence test. And this is now taking a look to see how much time have they spent here in the US versus other areas. And what we take a look at, we have a chart available on L1 of your 4012, which will go through and count the number of days individuals are present. Typically what we have to do is meet a minimum number of years over the past 3. Typically we would take a look at their presence here in the US. Most of the ones that we'd see within VITA are not traveling back and forth between the US and their home country. They're typically immigrating here. So what we would see is that they would have a substantial presence test if they meet the day's requirement. And if those meet the day's requirement, then they'll meet the resident alien requirement based on substantial presence, and we can prepare the return as if they were a US citizen. Now just bear in mind, one unique aspect we have, you may not be fully eligible for all the tax credits if you are a first-year resident alien. So in order to get things like the earned income credit, the child tax credit, you have to be a citizen or resident for the entire year. So you can't come in and take some of the credits and benefits. Now, again, the system will go ahead and work with that situation here for us. So a couple of things that we had talked about last session would carry over as well. So just some areas we'd have to take a look at for resident alien tax issues, just something to be aware of. Again, we're not going to see these at all sites. A couple of the sites will be more located here within the city. A couple maybe out on Harrisburg Pike location, I believe, which may see a few more refugee or non-resident alien situations. If you do get one, feel free to ask questions because we've seen a lot of these. And the first time you may go through the substantial presence test may seem a little daunting. It's really counting the number of days that people have been here in the US. So again, L1 and your 4012 will help you through that. Again, probably reserve more for advanced preparers. But if you do get one, simply go ahead and ask your site coordinator or some others for help. These do take a little bit more time, perhaps getting through the documentation. A couple other things that we did want to mention about the returns. Typically for return purposes, we would want to have everyone have a social security number, which would mean that they're actually valid for working here in the US. However, usually with the status of immigration, we may not have people who have fully gotten a social security number yet. So the IRS will issue what they call an ITIN, which is a identification number for tax purposes only. It's not a social security number. In fact, you may get these documents that say that they get a W-2 that has a social security number on, which is different from their ITIN. Now what we want to do is we want to input the W-2 exactly as shown when it comes in, but the primary identification number the IRS wants to see is the ITIN. So don't use the W-2 information as the primary social security number. Sometimes they will actually create one for them for work purposes, but their ITIN is what the IRS is going to need to see for processing a return. There may also be an adoption tax identification number. This is generally when a child is in process of going through the adoption cycle and may get a temporary number assigned to them before a full social security number is issued. And that's basically as you're finalizing the adoption process. We see a lot more, obviously, social security numbers, ITINs. On occasion, we may see an ATIN. These are all going to be required if you want to file a return, particularly for earned income credit and child tax credit purposes. And as I mentioned at the bottom there, the ITINs may be issued as persons going through immigration, but they may get a social security card as well, but that's not going to be valid for work or valid for work purposes only. So the W-2 may not entirely match. Again, just enter the W-2 as you see it and use the ITIN as your primary number here for tax purposes. If they do have an ITIN, they're not eligible for the earned income credit. So that will not allow them to take the earned income credit unless they have a social security card. Likewise, dependents who have ITINs are not eligible for the child tax credit. So we basically have to take a look at the process and make sure that they are pretty much fully gone through the residency program and issued social security numbers before they're eligible for EIC and also for the child tax. All right, so for those of you who are on basic certification and hopefully you enjoyed your snacks, we'll get back to the regular part of the program here and talk a little bit more about one of the only major changes we have in taxes between last year and this year. And this is an area that we have spent a lot of time on in the past, the Affordable Care Act. One major change that we have is you no longer have to have health care coverage. The shared responsibility payment is not applicable for 2019 returns. So all the slides that we went through before, talking about minimal essential coverage, whether or not they had it, asking questions, understanding whether or not they had it for every month of the year for every member of their household, and then going through a litany of exceptions which would allow them to get out of the shared responsibility payment. We don't have to do that anymore. The only thing that we have to ask is, did you at any point in time have health insurance that you purchased through the marketplace or healthcare.gov? If so, that individual should be receiving a Form 1095-A. We need the Form 1095-A in order to complete the return. But no longer do we have a shared responsibility payment. So all those exceptions we talked about, short-term coverage gap, incarceration, coverage unaffordable, we don't need to worry about it anymore. This is now gone for the 2019 returns. So hopefully a major benefit here. The main thing we're looking at is really just asking that one question. Did you have health insurance that you purchased through the marketplace? If so, we'll be looking for that Form 1095-A. We'll give you a little bit more information here just to follow up with a client. If they do come in and the 1095-A does not appear to be correct, they will have to get that reissued by the marketplace. So they will need to contact the marketplace. We'll provide a phone number that they can call, but we have to have a valid 1095-A in order to complete the return. And the reason why is generally what we're going to see here is because of the premium tax credit. Most individuals have gone on the marketplace, particularly those coming into VITA, have told the marketplace that they will be eligible for a premium tax credit by estimating their income when they sign up for marketplace coverage. As a reminder, the marketplace is open for coverage, I believe, through the end of this week for coverage beginning in January for those that might be interested in marketplace coverage. But when you sign up with the marketplace, you're going to estimate the amount of income you anticipate to have. One of the main areas that they do this for is because depending on your income level, they will provide a credit against your insurance premiums for the month. So the main benefit of going through the marketplace is getting what we call the advanced premium tax credit, which will lower your monthly insurance cost. So it's a great opportunity as long as you estimated your monthly income correctly. It's a great way to reduce the amount that you have to pay for monthly insurance. And one of those areas we take a look at is as long as you're between 100 and 400% of the federal poverty level with your family income, you should be eligible for the advanced premium credit. We have run into issues in the past where people's incomes have changed since what they had told the marketplace. And that's what we really want to try and get into here and spend a little bit more time talking about what we do with the advanced premium credit and handling some issues that may arise from there. So again, the advanced premium credit, I believe most individuals that have signed up for the marketplace within VITA will be having an advanced premium credit that will be shown on their 1095-A. So the information that you get on the 1095-A, again, we just want to be sure that the taxpayer feels is accurate. If they don't, I'm starting to get into a double negative myself here. If they don't feel it's not accurate, it probably means it's good. If they look at it and say, I have no idea if this is accurate or not, then we're probably good to go. We don't need to go ahead and call the marketplace and double check it. The only time we'd have to go ahead and inquire more is if they know that there's something that's clearly missing on there, that perhaps there's a couple months of coverage that aren't included, or they may have changed providers and there's a couple things that are missing. But otherwise, we'll be taking the 1095-A as it's presented and entering the information directly in a tax layer. We must file a return if they've received a 1095-A. The government will be looking for that, irrespective of when we talked about filing status and whether or not someone needs to file a return. If they have marketplace coverage and they're getting a Form 1095-A, they need to file a return. It's a mandatory requirement. These forms should be received by January 31st, as long as all goes well with the printing office. It has been a little bit better over the past couple of years. The first year was not so good in terms of getting these things out timely and accurately. Now, if they did not get the form or they forgot to get a copy of it or forgot to bring it in, they can log into their marketplace account and actually bring up a form for us. Generally, it'd be nice, well, you need to have that form in order to prepare the return. If they don't know how to log into their account, they can call the marketplace as well. There is an 800 number that we've listed in our slide set. It's also listed in H7 of your 4012. That number is 1-800-318-2596. So that's the number that people can call to get a hold of the marketplace. They can go ahead and request an additional 1095-A. They can call if there's any questions with the 1095-A, or more importantly, what we highly encourage them to do, if they know there's a change in their income, to call the marketplace and let them know my income has changed. So you may need to adjust my advanced premium tax credit, because what typically happens if we see these changes throughout the year, the individual still getting the same amount of tax credit against their insurance premium. So it's going to be reducing their monthly cost. Again, it's based off their initial estimate. If their income changes for some reason, usually our taxpayers' income goes higher then goes lower. Taxslayer will automatically recalculate the amount of credit that they're supposed to have received. So we don't have to do anything. There's no manual calculation. There's no handwritten form we need to fill out. Taxslayer will do this for us. If for some reason the taxpayer estimated more income than what they actually received, they will get the additional credit back with their return. That's a good situation. That doesn't happen all that often, where people have overestimated the amount that they think they're going to earn for the next year. We probably will be taking a look at the second situation, where their income has changed and gone up from what they told the marketplace. And this is a situation where we run into that now part of their credit, or all, may be repaid to the government. Not to scare anyone, but we've seen situations in the past where if you've gone above the 400% poverty level, that this could be a payment back of $13,000 to $15,000, depending on how much they've taken in a credit. Because once you're above 400% of the federal poverty level, you are not eligible for the advanced premium credit. So the entire amount would be coming back in one lump sum. Now, not to fear, we do have some opportunities we can take a look at. I think I mentioned back when we talked about income that we had the clean extra facial tissue code of the code 1 in the 1099-R. The biggest one will be a 400% poverty level with advanced premium credit coming in, that they say, oh, I forgot to tell you, I went to the casino last year and I won $30,000. That was a great day for me. Well, today's not a good day for you as we go ahead and talk about what that means on your tax return. Probably something you should go ahead and inform the marketplace that your income has changed. I'm glad that you got a great new promotion at work, or you have a full-time job now but not eligible for health insurance. Call the marketplace and let them know that there is a change. So those are the main things we want to try and take a look at, but we'll give you some advice on what to do if there are some issues with the calculations. So we do want to highly encourage people to go ahead and contact the marketplace anytime there is any type of change. New child, change in marital situation, a change in income. Always call the marketplace and let them know. They can walk through that scenario. By the time they come into us, it's already too late. We can't do much about what happened in the prior year. Now, there are fortunately some options we have. And I actually ran into the situation last tax season where I had an individual come in actually on April 15th. I thought, oh, this should be fun. Well, go ahead. There's a reason why they came in late. The fortunate situation for us is we were able to fix the issue. Situation that had occurred, individual was married, her husband had passed away during the year. What had happened was they had a retirement plan. She decided she'll just go ahead and cash out the retirement plan that year without consulting anyone about what to do. That obviously had brought a bunch of additional income in. Fortunately for her, no additional penalty on it, but increased taxable income above the 400% federal poverty level. And ironically, I've been joking to say, well, you know, we've seen some situations where people may end up owing $15,000 back. Lo and behold, she ended up owing about $15,000 back to the government because she was over the 400% federal poverty level. Now, the fortunate situation, we do have some after tax year planning strategies. Because she was eligible, we were able to make an IRA contribution for her up to the due date of the return, and we actually could have extended the return if we needed to. But by making an IRA deductible contribution, that dropped her income below the 400% federal poverty level. So most people coming into VITA, we have some room because their income level is already set at relatively around $62,000 to $65,000. We may be able to reduce their income below that 400%, which once they're under the 400%, not all of it gets repaid. It's only a select portion. So a couple areas we take a look at. IRA contributions, if they're eligible, could help get them beneath the 400% federal poverty level. Another issue that we had talked about one of our sessions, health savings accounts. So you can make an after-tax year deduction, deductible contribution to your HSA, which would reduce your taxable income. So if we do run into a situation where someone has an advanced premium credit repayment, particularly if they've gone over the 400% federal poverty level, and again, you don't need to memorize any of these, the system will do it for you. There may be some options we can take a look at. So the option is either they try and pay the amount to the government back for the premium credit they received, or they could put it in their own account for future purposes by establishing an IRA or doing a health savings account if they were already eligible. So we do have some options that we can work with there. So that's about the worst news of the day whenever we have the 400% federal poverty level. In most cases, people may be sliding a little bit on the scale. If you estimated that you'd have $25,000 of income for 2019 and you end up having 26,500, it will recalculate and it may have a bit of a repayment of the credit. It won't be that significant. Hopefully they're already eligible for other credits or already have a refund, so it's just going to simply reduce the refund. The only area that we have to walk around is at 400% level. If they get over that, that's when we have a relatively large repayment. So don't want to scare anyone, but that's really the main issue that we have in terms of the Affordable Care Act in having those repayments. And again, if you see this, be aware that we've seen it already here at the site. So even though for the client it may be their first time, for you it may be the first time, but we've dealt with these situations. They're not going to be in a hurry to try and get out of there right away to get their tax return done. They're probably more than willing to have some additional time spent to see what we can do to help come up with some strategies to help reduce the amount of taxes owed. So certainly not a big issue if you run into those, that we can try and walk through as best we can, try and explain to the client why it happened. If they continue to be on the marketplace, ask them to make sure that they are updating their information as best possible with the marketplace so they can adjust the advanced premium credit. But the good news is we shaved off about 45 minutes of the presentation without having to go through all of our exceptions to the shared responsibility payment. No longer applicable. So feel free to get health insurance or not. It's entirely your option now at this point. No shared health responsibility payment for 2019. Now, given the fact that 2020 is an election year, we'll see what happens in subsequent years. So I haven't thrown out my old slide deck yet. I may need to bring that back at some point here. But for this year, much, much easier. The only question we need to ask, did you have health insurance through the marketplace? We'll just enter the information right from the 1095A, and we'll let the system do some calculations. So we'll walk through that a little bit more as we get to the actual computer training at HAC a little bit earlier in January. Okay, so kind of switching gears, we'll kind of put your 4012 down for the rest of the session here and talk about state and local issues. So the VITA does a great job of getting you trained for the federal taxes. The 4012, you have practice exams, you have the Lincoln Learn, but they don't really have much on state. And one of the unique parts is Pennsylvania is one of the more unique states that you'll ever find in terms of how taxes are calculated. Most of the others that have a state income tax will just say, you know what, Fed does a pretty good job, we think. We'll just use their federal income to start, and we'll make a couple adjustments. Pennsylvania has this whole different concept to say, nope, we're unique. We're a commonwealth. We're not actually a state. So we're going to actually do our own thing. We're going to go ahead and create our own system of taxation that's completely different from the federal system in terms of how you're going to be taking a look at information. In fact, what we take a look at here is how we want to go ahead and describe the state system. It's going to be a little bit more complex than a federal return, not in terms of what we need to do. So everything we're going to do is going to flow through automatically on TaxSlayer. But I want to just show you what the differences are. For Pennsylvania purposes, we had talked a little bit about filing status. So for federal, you didn't have to file a return if your gross income was beneath a certain threshold or depending on your filing status. For Pennsylvania, you need to file a return if you have $33 of income. Now, that's not a whole lot of income, right? Now, for interest, that's a lot of interest, right? $33 of interest income is a lot of interest income for 2019. But if you have just $33 of income, Pennsylvania is going to be looking for an income tax return for you. Now, we will talk about some things that are going to be taxable and non-taxable for PA. But if you have gross income of $33 or more, you need to file a PA return. Also, if you have a loss from some sort of transaction from a partnership or S corporation or Schedule C, that will be in scope next week if you're here for the advanced session. Self-employment income, you need to file a return there. There are no exceptions for minors. So unlike Lancaster County, where you don't have to file a return if you're under the age of 16, if someone gave a child as a gift, which would be fun, why don't we give them some Walt Disney stock? And they get $34 of dividends from Walt Disney stock, they technically would need to file a Pennsylvania return. I say technically, because that would be the rules for Pennsylvania. So there's no exception for a minor. That doesn't mean if you pay them to go mow the lawn that they now have to file a Schedule C if they're 8 years old. Don't know what OSHA would say about an 8-year-old mowing the lawn, but I have seen some Amish kids do it, so apparently it's okay. But what we take a look at there is you have a $33 threshold. If you're $33 or more, Pennsylvania will be looking for a return. For Lancaster County, just as a reminder, if you have a earned income from 2019, whether you're living in Lancaster County or in the Octorara School District over in Chester County, that you would have to file a return. We had covered that a little bit back in our income session. It would be applicable for anyone age 16 or older. So if you're under 16 for Lancaster County, you should not have to file a return, and it's only based on earned income. For Pennsylvania, it's based on all income sources that we'll talk about in just a second. Now, what's unique about Pennsylvania is that there are actually 8 different classes of income. What's also unique about Pennsylvania is that they will not allow one category of income to offset another. So if you have a loss in one category, it does not allow you to subtract that from income in another. So let's just say, for example, you had capital losses. If you sold some stock at a loss, that's great. You can deduct it for federal purposes. You cannot deduct it for Pennsylvania purposes. You can't use that to offset your wage income. One other unique aspect about Pennsylvania, even though it looks like a joint return, there's only one column. It's not a joint return. It's actually 2 separate returns on one sheet. Now, Lancaster County gets this concept to say if it's a separate return, let's have 2 different columns. That works out well. Pennsylvania has 1 column. So spouse's losses can't offset another spouse's gains. So if we talk next week about advanced topics with self-employment income, if one spouse has a sole proprietor business that earns $1,000 and another one has their startup business and it lost $500, for federal purposes, we have $500 total income. For Pennsylvania, guess what we show on the return? $1,000, because the spouse's half or $500 loss cannot offset another spouse's income. So the return may look a little odd as you take a look at it, and you're thinking, why'd TaxSlayer mess up the math? They didn't. Pennsylvania looks a little weird when you see the returns, because you can't take negative numbers on the Pennsylvania return. So you're only going to add positive items. We don't get to subtract items. If one spouse has a loss, you cannot use that to offset income from another. But let's take a look a little bit more about these 8 classes, and this won't really, we'll kind of talk a little bit more about how these will be applicable. So the first thing we're going to take a look at is wages. So wages are going to be pretty much coming right off the W-2. I'll be talking a little bit more about kind of our state taxable income off the W-2. It may be different from federal. A lot of cases it will be. So as long as we enter the W-2 correctly, it's going to flow directly to the Pennsylvania return. A couple other things we take a look at would be interest is on its own separate line. Dividends have their own category. Business income, again, a topic we'll talk about next session, will be its own separate category. So that would be any type of self-employment income, income coming from a S corporation or partnership. Gains or losses from sale of property, again, an advanced topic, which we'll be covering in our next session. The next 2 are not going to be within VITA scope. These are going to be rents and royalties. So we don't actually cover rents and royalties within VITA. Same thing with the state and trust income. So those are going to be areas that are not within scope for VITA. So those are 6 and 7 are not within scope. Number 8, our famous gambling issue, when someone decides that they wanted to go try their luck at the casino and they did very well enough to put them out of the advanced premium credit. That's also going to be taxable for PA. PA made a change a couple years ago that Powerball tickets, if you bought them in certain areas, it may not be taxable. Now, any of your gambling winnings are going to be taxable in PA. So if you enjoy a Pennsylvania casino, it's taxable. If you prefer to go to Atlantic City, it's taxable. If you buy your Powerball ticket in Delaware when you're away on vacation, it's taxable. Buy your Powerball ticket here in PA, it's taxable. It doesn't matter where you buy it anymore. Powerball tickets, Mega Million tickets are going to be taxable within Pennsylvania. They used to have some exceptions where you bought the ticket before. That's no longer the case. So when we take a look at gambling and lottery winnings, they're all going to be taxable within PA. Now, the good news for Pennsylvania, they don't tax a lot of things. You may notice we have a lot of retirement communities here in Pennsylvania, and it's not because the weather is fantastic in the wintertime. We don't have shuffleboard year round, but what we have here in Pennsylvania is the ability to not tax a lot of income for seniors. We don't tax Social Security. We don't tax railroad retirement benefits. We don't tax pensions or retirement distributions. There is an asterisk there. As long as it's taken during normal retirement or on account of death, it is not taxable for PA. We mentioned during the income session, if they do have an early withdrawal from their retirement account that will be taxable, that is going to be based on our aspect of cost recovery first. So if we do have an early withdrawal from a retirement account, we need to do some calculations. Unemployment compensation is not taxable. Sick pay and disability is not taxable. Alimony, inheritances, any type of death benefits that people may receive are not taxable. Likewise, active military duty pay is not taxable here in Pennsylvania either. So even though we have a different system of taxation, they really have excluded a lot of different concepts from what can be part of taxable income. In fact, a lot of seniors may not even have a state tax liability because if we've taken out their retirement distributions, if we've taken out Social Security, the only thing that's really left is going to be interest, dividends, and capital gains, or gambling if they decide to go to the casino. But really, we take a look at only a couple areas that are going to be taxable. So I'll take a look, a little deeper dive into some of these areas. So first one to start about wage compensation. You will notice that there is a new page that pops up. It's been there for a couple years. It's called a W-2S. And the ability here for the W-2S is it actually provides all the information the government needs to prepare a return electronically. We do not need to send any 10 W-2s into Pennsylvania. All the information on the W-2S will take care of the IRS and Pennsylvania matching up the information. So the W-2S is going to be generally right behind the PA-40 when it comes out of your tax program. It's going to list all of your wages by taxpayer and spouse with the employer identification number. At the bottom of the form, it's also going to list all your 1099-Rs so the state knows whether or not it's taxable. But generally what we want to just watch for is that typically your W-2 may be different for federal taxable wages than it is for state. VITA does a great job of TaxSlayer thinking that it will automatically help you fill out the W-2. But once you put something in line 1 of the W-2, it's going to try and put that as taxable income throughout. That may not be entirely the case. You may want to just double check your Medicare and Social Security may be different because of information in box 12. Likewise, state's probably going to be different as well, particularly if they have payments to a retirement plan. So any type of voluntary contribution to a retirement plan is not deductible for Pennsylvania purpose. And you're like, that doesn't sound fair. But we just got done telling you you don't have to pay any income on your retirement distributions. So theoretically, Pennsylvania kind of started the Roth program many years ago by saying contributions to a retirement plan aren't deductible, but we're not going to tax you on anything you pull back out. So it's a really nice benefit that you don't have to pay money on your retirement distributions. Really great if you moved here from a state like New York or New Jersey that allowed you to take a deduction when you put them in, and then when you come here to PA, you don't have to pay tax when you take them back out again. So it's a really nice gamesmanship on tax planning from that way. So Pennsylvania wages are probably going to be different. We just want to take a look at box 16. Once we enter that information in TaxSlayer, it's automatically going to flow over to the correct form. So it's first going to go to the W-2S and then move over to our compensation line on the PA-40. So again, box 16 is going to show our state income. Box 17 will be our state withholdings. One thing we do just want to watch is sometimes employers get a little excited about what information they put down on boxes 16 and 17. Things like LST or state unemployment insurance should not be on those boxes. They should theoretically be in box 14. So just double check when you enter the wages that it appears to be a state wage. One way to double check is that the state generally would assume that your Medicare wages are going to be what your state taxable wages should be. So the definition for PA compensation is effectively the same as what Medicare wages would be. So if there's some question about it, we need just to reconcile between state and Medicare. Generally, for the most part, the W-2 should be pretty clean to be able to walk through. Just want to watch in case you have some additional things that pop up there. Some employers like to put a whole lot more information on the W-2. One other item that we have with compensation is that we actually have reciprocal agreements with certain states. And I'd like to say surrounding states, but one of the first states we're going to mention here is Indiana. Don't know the last time you may have taken a look at a map, but we don't actually border Indiana. So I'm not quite sure where in the history of tax negotiation that someone says, I enjoy commuting to Indiana daily for work from Pennsylvania. So I have to drive through a couple states to get to Indiana. But what happens with a reciprocal agreement means that if you have an employee who lives in one state but works in another, that the states have agreed that they do not have to withhold taxes for the state in which they work, they will actually withhold taxes for the state in which you live. So particularly here in Lancaster County, we may have individuals who, particularly on the southern end, may be working in Maryland. So the nice part about the reciprocal agreement means even though they work in Maryland, the Maryland employer should be withholding Pennsylvania income taxes, not Maryland. So Maryland's one of the reciprocal states, New Jersey, Ohio, which we do border, Virginia, close, West Virginia, touches a little bit near Pittsburgh, and then Indiana. I, again, still don't know where that came from. You'll notice there's two that we do border that are not on here, Delaware and New York. They do not have reciprocal agreements. So as we mentioned before, we may have some multi-state issues if you have someone who's working in Delaware or New York, that they may have to file 2 returns. And unfortunately, that issue becomes a little too complex for VITA, mainly because it's very complex for tax layers. So if we have issues where they have out-of-state returns, we unfortunately cannot handle those within our system. If someone has worked in these states, the reciprocal ones, they should have PA taxes withheld. Just bear in mind, the employer may hold Pennsylvania. They're probably not going to bother to withhold local taxes. So that would still be on the employee to have to pay their local taxes to the LCTCB. But just want to give you a little bit more information on that reciprocal state nature, that we do have the ability, if someone works in a different location, they can still have Pennsylvania taxes withheld, which makes our tax prep a whole lot easier. One unique area that we have for Pennsylvania that we no longer have for federal is unreimbursed employee expenses. So while federal has gotten rid of unreimbursed employee expenses for itemized deductions, which you'll hear a little bit more about next week, Pennsylvania still allows these. And what we want to take a look at are types of expenses that you've incurred while actively employed that are needed for the business. So what we have to take a look at are whether or not these expenses are what we call ordinary, customary, and reasonable in nature, generally accepted in the industry, that they're paid while performing your duties of employment, that they're not excessive in nature, that they're necessary for you to perform your job, and they're directly related to your job performance. So a whole lot of things to go over what the actual rules are. Now, I will mention the government has actually been a little bit more aggressive in following up on these unreimbursed employee expenses. So we have seen a lot more notices coming out of the Department of Revenue asking people to verify the amount of unreimbursed employee expenses that they have. Now, not to scare you, because most of the people we have within VITA are going to qualify for some of these, and I'll kind of mention the common ones we have. But in order to get a unreimbursed employee expense deduction, your employer will not reimburse you for your expenses. So if they have the opportunity to reimburse you and you chose not to be reimbursed, Pennsylvania will not let you take a deduction. You have to go through your employer. So if someone comes in and says, well, I have a bunch of meal receipts and mileage, I didn't turn into my employer because I didn't want to, or I forgot to do it. Well, unfortunately, Pennsylvania's going to say, you had the opportunity to get the money from them. We're not going to give you the money. You had a very valid vehicle to get the money. So you should have gone to your employer first. Now, again, we're not going to see that very often, but just as you start asking people, typically you may find if you take a look at the prior year return, you may have seen that there's unreimbursed employee expenses from the prior year, or they may be coming in and saying, I have some business expenses. Can I write those off? Biggest ones we're going to see are going to be things like union dues. So a lot of educators, people in mechanical trades may have union dues. Those are deductible for Pennsylvania purposes. Things like work, clothing, and uniforms. Now, a little bit of a kind of a rule for these. They have to be purchased by the employee and not suitable for general use. So if you have an outside contractor or landscaper that says, I needed a nice warm jacket to perform my duties, which also helps me to go hunting in the woods, that is not an employee business expense. That's a multi-purpose jacket. What we're looking at are things like perhaps safety shoes, work tools, things like your safety glasses, steel tip boots, that type of thing that you may be required to purchase. Particularly if you're in the healthcare or food service, non-slip shoes may be appropriate. Kind of the general rule was if these were things you could only wear in work and not out in public, they'd be deductible. Not quite sure if you've walked around in public lately, but apparently dress codes are a little looser in standards now. So apparently you can walk into Walmart in your pajamas and no one really cares anymore. So we used to say that if you had to buy that safety vest because you're working out on a highway so people don't hit you, that would be deductible because you wouldn't wear it out in public. Now apparently it's new fashion wear. So it just has to be, if it's used in connection of your business, it can potentially be a deductible expense. Things like small tools and supplies, we may see these as people might be in areas like repair work. They might be going ahead and rather than going back to the shop, they're actually getting materials or supplies to carry in their truck. Things like professional license fees, if your employer does not reimburse those. If you have professional licensing fees, whether it's, I've seen some hairdressers that have to get their cosmetology license that is not being reimbursed. Things like plumbing licenses or other type of professional licensure may be deductible. Vehicle expenses, again, if your employer does not reimburse, you can take those. But if your employer reimburses at any amount, you cannot take vehicle mileage. So I know some employers, while they can go up to the federal level, which is a standard mileage rate, some employers say we will reimburse you at something less than that. You cannot take the difference on your PA return. If your employer reimburses you any type of mileage at any rate, you cannot take mileage expense on your PA 40. And again, the only reason I want to caution that is because the Commonwealth has really been tracking down and sending notices out on relatively insignificant amounts, trying to get additional information, requesting that you get a letter from your employer stating that they will not reimburse you, or you need a signed affidavit saying that these expenses are valid. So I just want to have some caution as we walk into these, just to be sure people come in and say, hey, I want to take all these expenses off my PA return because I have a little bit of other income and I don't want to pay tax. If you have valid expenses, it's perfectly acceptable to take those as unreimbursed. But we also have to be sure that you're following the rules. If the employer has a mechanism for you to get reimbursed, you're not eligible to take these on the PA return. But a lot of things we'll see, things like our union dues, our work uniforms, that type of thing are generally going to be fine. Travel expenses could work too. Any type of parking fees and tolls, as long as you're not reimbursed by the employer, should be fine. Meals and entertainment, Pennsylvania allows those deductible at 100%. Federal has a 50% limit that we'll talk about for business deduction. But if you have any of those expenses, just enter them in the tax layer and the adjustment column, and it will go ahead and take that into account. The other thing I want to kind of point out here with your small tool and supplies, mentioned educators with union dues. The educator expense that we had talked about with the adjustments is also eligible for PA. So if you're taking the educator deduction of $250, that's also eligible for an unreimbursed expense. Now for federal, you have a $250 cap. There is no cap for Pennsylvania purposes. So if someone comes in and they have $310 of educator expense, we can take $250 on the federal return, but we can actually take the $310 for Pennsylvania UE. The nice part about the Pennsylvania UE, it also counts for local taxes. So if you can deduct it for Pennsylvania, you can also deduct it for Lancaster County. So if you're able to take UE expense, you can actually take that for local as well. Okay, wanted to hop over to interest income, and interest income is pretty much similar to what you'll see off the federal return. There are a couple exceptions. Pennsylvania cannot tax certain items of interest, including US government interest. So the government will not allow any state to tax any interest that they pay. So things like US savings bond interest will not be taxable for state purposes. PA will also not tax any of their own interest. So if you have a some sort of interest payment from Pennsylvania, it's not going to be taxable. Likewise, any municipality or connected government to Pennsylvania. So if you have municipal bonds here in Pennsylvania, they are not taxable either. So if you decided to buy a local school district bond to help fund capital projects, the interest is not taxable for PA. It's also not taxable for federal either. So we're looking at basically they cannot tax federal government interest, state government interest, local government interest, or if you happen to have bought a bond from Puerto Rico, the Virgin Islands, or Guam, you are so exempt from income on those. Now, I'm not quite sure. I ask every year if anyone's ever seen a bond from Guam, because I'm really curious to see what these things look like. They are part of our tax exemption. So no interest on Guam bonds, but anyone sees one, slyly make a photocopy of it. I'd greatly appreciate to see what that thing looks like, and we'll see how that plays out. Or if you have an investment broker, just mention what the rates on bonds from Guam would be, see if it's an appropriate investment option for you. But so those are the things that we take a look at for exempt issues. If we do need to make a modification for interest, if you go into tax layer under the interest category, there's a tab that'll actually have a adjustment amount that we can put in for Pennsylvania. So sometimes where you may see this could be a situation where we have a investment in a couple different municipal bonds. If you have a managed account with a broker, they may have you invested in a number of mutual funds, or I'm sorry, municipal bonds. The amount from Pennsylvania municipal bonds is going to be tax exempt. The amount from other states' municipal bonds will be taxable. So sometimes you may see that there's tax exempt interest reported on a 1099 INT. We may have to go into a little bit more detail and say how much of that's taxable in PA and how much is not. Most cases, I think we're looking at pretty much 100% is invested in Pennsylvania municipal bonds, but if someone got excited and said, oh, I want to buy a bond in Tennessee, that bond interest will be taxable for PA. So just a few little areas we have to take a look at there. Again, we'll probably see that a little bit more as an advanced concept as we kind of go through. One other thing I just want to kind of mention there about the interest category. If you recall when we talked about 1099Rs, that if you see a code 7D, that is a normal distribution from a non-retirement annuity account. The D part indicates it's a non-retirement annuity. So any taxable amount for federal purposes is going to show up as Pennsylvania interest income. So as long as it's entered into tax layer, that amount will show up as interest income on the PA return. So if you're taking a look and saying, I don't know why my interest line is so much different than federal, it's because if you have a 7D, that taxable amount will show up as interest on the PA return. Fortunately, dividends are fairly straightforward. The only issue that we run into with dividends is they will actually move their capital gain distributions up to a dividend category. So if you take a look at the PA 40 relative to the 1040 return, you may see some numbers moving to different categories. That's probably going to be perfectly acceptable the way that the system goes ahead and enters the information. In most cases, most of our clients here, probably 97.4%, there won't be a whole lot of differences in how the categories are going to run. You may see differences in wages between federal and state, but that's pretty much the main adjustment we're going to have. Again, you'll probably want to ask for things like unreimbursed employee expenses and a couple other things, but really probably not a whole lot of difference. But if you're taking a look at the PA 40, you're like, this looks weird. Yes, it does. And it's supposed to look weird because we do a whole weird system of how we do a calculation. But it may not look exactly like you would expect the 1040 to look, particularly if you're new to VITA. A couple other things that I want to just mention. One area that we do have, Pennsylvania has a flat tax. It's one of the early adopters of a flat tax rate. A very easy to remember 3.07%, which may be changing based on the whims of the government here. But 3.07% is where we've been sitting for the past couple of years. So it's a flat tax. Now, what we do have instead, because we can't actually have under the guidelines of the Commonwealth, under our Constitution, we cannot have graduated tax rates. But someone was clever enough to figure out a way how we can actually back into that process by having what we call tax forgiveness. If the taxpayer qualifies, and believe in tax layer, you actually have to go in and indicate that they're eligible for tax forgiveness. And if you do that, it will automatically calculate whether they are. You have to go in and indicate that they are eligible for tax forgiveness. Now, this is a credit that will allow a taxpayer to reduce all or part of their PA taxable income. So this usually works well, particularly for seniors that may have a little bit of income coming through interest or dividends or something else that's not exempt for PA income tax. So generally go through, check the box that they could be eligible for SP, and it will go through a calculation. Now, I do want to make a caution. The very bottom note there says that if a taxpayer is a dependent of someone else, their parents or whoever's claiming them as a dependent on the return must also be eligible for tax forgiveness before they can be. So just want to give you a word of caution. If you're preparing a return for someone who's a dependent of someone else, don't automatically go in and check the box that they're eligible for SP, because most likely they'll probably get it. but they're not eligible unless the person claiming them as a dependent is also eligible for tax forgiveness. So best to err on the side of caution and let the PA calculation run through. Now, a couple different changes for SP. Now, we do have to add a couple things back. Most of these will be automatically coming through the system. Things like alimony have to be added back for tax forgiveness. So even though it's not taxable for PA purposes, again, kind of a difference in federal, it is added back for SP purposes. So it's added back for the SP determination. Same thing as our non-taxable interest. The things we just talked about, the tax-free interest for Pennsylvania is added back for SP purposes. The one area that we know that the system does not pick up is inheritance. So there's no place on the tax layer in the normal input area to put inheritance. So if someone does mention that they received inheritance money, you would have to manually enter that in for the SP to say that they actually have inherited income. So that would not be taxable for federal, not be taxable for PA, but it does impact the calculation for SP. Also, any non-taxable educational assistance. So the things that are going through tax-free, like scholarships, would have to be added to your eligible income for SP purposes. And if you had a sale of a primary residence that you did not pay tax on, that excluded gain would also have to be added back. So there are a couple things we may want to take a look at. Just want to make you aware of those. Those don't really apply in a lot of situations, but just want to make you aware that they could happen every once in a while. So just want to kind of point those out. A couple other issues I just want to mention about PA when we get into some other areas. I kind of already mentioned the annuity concept, that the code 7D in box 7 of the 1099-R will be reported as interest income. If we do have any type of early distribution from a retirement account, we do get to recover cost basis first. So if you've taken money out of a retirement account early, the earnings are going to be taxable in PA, not the original cost basis. But the amount that you put into that plan comes out before any earnings. So just a reminder when we had talked about that back in the income section. A couple other things I want to mention here about Pennsylvania as well is there's a question on the PA 40 called use tax. And the question is really kind of unique. It's asking effectively, do you wish to voluntarily report any use tax liability that you may have? And you can certainly ask that question to a client, and you're probably going to get a blank stare back to say, I don't even know what use tax is. I don't know if I have it. I don't really know if I want to voluntarily report it. And that's fine, because there's no mandate that you have to report your use tax as an individual. It's an opportunity for you to self-report and pay any use tax due to PA. And what use tax is effectively a corollary to sales tax. So here in Pennsylvania, we have to pay sales tax on a number of items. Certain things are exempt. Things like clothing, food, as long as it's not ready to eat, is exempt. If you go to other jurisdictions, the sales tax rates might be a little bit different. We border a state. That isn't very friendly for income tax purposes for us, but very friendly for sales tax. In fact, they mention that on their Welcome to Delaware sign, right? Home of tax-free shopping. If someone goes down to Delaware and decides that that'd be a great place for me to buy things like appliances, jewelry, furs, and you bring them back to Pennsylvania, you technically have a responsibility to pay use tax to PA. Because if you bought the items in Pennsylvania, you would have had to pay sales tax on them. So the Commonwealth feels that you're not paying your fair share of tax because you're purchasing items and using them in PA. So that's why we call it a use tax. So if anyone has bought things either out of state and brought them into the state, people buying things online and not paying the appropriate amount of tax, PA has a solution for you. If you would like to, you may self-report the amount of use tax that you owe. So the question is on the PA 40, do you have any use tax that you would like to report? A valid answer, and I believe for virtually 100%, although not 100% of clients, we actually do have a couple that would volunteer to pay some use tax. You can put no, I do not choose to voluntarily report any use tax with my PA 40, and that's a valid response. There's no mechanism for it. It's not under penalties of perjury that you actually have it. They just ask, would you like to report any? So 0 is an acceptable answer, and for most of our clients, that's what they're probably going to do. We have seen people that have come in and said, oh, by the way, I have a schedule of everything I purchased out of state that I'd like to report. Awesome, we can go ahead and do that. Give us a number and we'll put it on the return. we'll kind of show you how to do that. We don't see it very often, but if you want to, we certainly can go ahead and put your use tax on the PA return. Now, PA also has another option for you. If you haven't diligently calculated every purchase you made through the entire year, determine the sales taxability in the state in which you purchased it relative to the sales tax rules and regulations of the Commonwealth of Pennsylvania, and come up with a list to cross-verify all the information, come up with the total, and provide that sum to them. They'll allow you to estimate based on the amount of income you have. So a little chart we have at the bottom of your slide set here will just say, based on the taxpayer income, PA will go ahead and come up with an amount that they feel would be appropriate. Essentially, this is a voluntary contribution to the Department of Revenue if you so choose. If your income's under $15,000, they will be fine if you give them $6 to cover any use tax liability. If it's between $15,000 and $30,000, it goes all the way up to $12. And for VITA purposes, we'll cap it at $60,000 or $50,000 here, but $30,000 to $50,000, it goes up to $17. If you let the system do the calculation for you. I haven't really seen this very often, but effectively, it's kind of just like a, would you like to make a voluntary donation to the Commonwealth of Pennsylvania? One other area I do want to mention about Pennsylvania, typically we don't see a lot of deductions available like we do on the federal return, not a whole lot of adjustments. We do have that unreimbursed employee expense that I mentioned. You can't offset losses against other items of income. We may see something on a couple areas where it's called a Pennsylvania Schedule O. We don't see this very often within VITA clients, but I do just want to make you aware of some areas we have. Contributions to a 529 plan. You may make contributions to any individual on a 529 plan in any 529 plan program. So a 529 is a college savings program. So if you want to contribute on behalf of your children, yourself, your grandchildren, a friend, a relative, you may take a deduction on your Pennsylvania return for the amount of the 529 contribution, subject to some limits. You would need to have the Social Security number of the individual, but you can take a deduction on the Schedule O. Another thing that's eligible on the Schedule O are any contributions to an HSA. So it will automatically populate through TaxSlayer if you do an HSA contribution on the federal level. It should also come over to PA. One other item that Pennsylvania has relatively new is what we call a PA ABLE account. PA ABLE account is similar to a Section 529 plan. It allows you to put money into a program. 529 is designed for educational purposes, qualified higher education costs. A PA ABLE account is designed to help individuals with disability cover their other expenses. So the traditional amount is $15,000 per year, can go into a PA ABLE account for an individual. If they have earned income, that amount can go up even higher. I don't know if we'll see a whole lot of these coming in through VITA, but just want to make you aware of the items that are eligible for deduction for PA income tax purposes. So again, on the Schedule O would be any 529 contributions, PA ABLE account, or an HSA contribution are all deductible for PA. Now, a couple other things I just want to mention about Pennsylvania is we need to understand what their school tax code is. So a lot of times what we'll take a look at, if they had a prior year return, they didn't change their address, that should pretty much be good to go. Oftentimes, if we use a municipal lookup feature, that will also let us know what school district they're in. The fortunate part, most people kind of know what school district they're in because they have to pay school district taxes. So they kind of know where they're getting their bill from for the most part. So we have a listing here of all the school districts within Lancaster County, including Octorara. So the codes are available there. There are a 5-digit code that have to be entered as you start the individual process. So as you're doing TaxSlayer, it's actually going to ask for your tax code pretty much right away. Now, one of the other things we talk about for Pennsylvania purposes is kind of our ability to provide some nice benefit for seniors. So I mentioned that seniors, for the most part, may not have a whole lot of taxable income. Social Security, retirement income is not taxable for PA. If they have a little bit of interest in dividend, perhaps they get the Schedule SP tax forgiveness. But one of the main areas we may see of a benefit for seniors is our rent rebate and property tax claims. We actually have people who come in to VITA just to handle the PA property tax and rent rebate. So the program's actually offered for 3 different groups of individuals. One is individuals who are age 65 or older. The next group is widows or widowers age 50 or older, and anyone with disabilities age 18 or older. So what we take a look at is the income limits. These change a little bit when you take a look at the PA websites. They're still using the $35,000 and the $15,000, but the calculations actually kind of increase a little bit. So these are a little bit different in how we go through the calculation. So homeowners, if you have a home ownership, as long as your income is less than around, it's actually a little closer to $36,000, but if less than $36,000, you can be eligible for the homeowner credit. If your income is less than about $15,700, you can be eligible for the rent rebate credit. Now, when we take a look at your income, we have to add back a couple little things from your PA taxable income. 50% of your Social Security and railroad retirement benefits are excluded. So 50% is excluded, 50% gets added back to the calculation. Similar to the Schedule SP, we do have to add back things like inheritance, alimony, spousal support, and gain from sale of a personal residence. So just to be cautious, if someone sells a home in a year, and we sometimes see this with seniors that are downsizing, they move out of their principal residence, they decide to move into a smaller place or retirement community. Fortunate part, we tell them, hey, don't worry about your gain on your home. That's going to be excluded for federal purposes. However, just bear in mind that that excluded gain may prevent them from taking SP and the property tax rent rebate for that year, because that gain needs to be added back to that calculation. So the benefit is basically our standard amount is $650. That's kind of our top level. But don't be concerned if someone comes back and says, oh, by the way, I got a whole lot more than $650 back. What did you guys mess up? Or should I be concerned that the government's going to be waiting for me outside my house to take my money back? No, because fortunately, even though 650 is kind of the top bracket that you'll see in a lot of the discussion, you actually can get an additional rebate. So they'll actually automatically increase the rebate at the state level. It'll be increased by 50% as long as their income's under $30,000 and more than 15% of their income is paid for property taxes. So if they're in a relatively higher property tax jurisdiction and their income is relatively low, they may get more than $650 back. So this Commonwealth will actually calculate that for them. Generally, we will actually go ahead and do these returns while we prepare the PA 40. So it's pretty much done at the same time. The actual deadline is June 30, which every year they extend all the way through the end of the year. I don't know why they just don't say, hey, December 31st, because they do it June 30th and then immediately thereafter they extend it anyway. But we can prepare these returns pretty much at any time, but generally it works well because we have all the information we pretty much need as we enter the 1040 information. So if they don't have a federal liability, even if they don't have a state liability, and they probably don't have a local tax, we can still prepare a PA property tax rent rebate for them. So just to give you a quick little chart of where this will probably fall out. Again, these rates will be changing a little bit just based on cost of living indicators. But the maximum rebate is when we're taking a look at less than $8,000 for a homeowner. So less than $8,000 of qualified income. Again, what we're going to exclude is half their Social Security. So that'll be an excluded item. Can go all the way up to around $35,000. Again, with COLA, it goes a little bit higher, but they can still get a benefit of $250 rent rebate. For renters, it's actually a little bit lower. So they can only go up to about $15,000 of income to get their full $250 credit. Or I'm sorry, $500 credit for the rent rebate. So it does kind of slide down a little bit as their income increases. So we do have to watch when people are kind of very near the edge. Have they gone over? Sometimes people may qualify for 1 year and then not qualify the next year depending on other income circumstances. So a couple things we want to take a look at with our property tax rent rebate is really what do we need to do to prepare the form. Fortunately, the form will be prepared out of TaxSlayer, but there may be a couple attachments that we need to go ahead and put together. If you take a look at the instructions, it wants to verify your amount of Social Security income. Now, if the taxpayers lived in Pennsylvania for the entire year, we do not need to send any SSA 1099s. That's automatically going to be calculated from the Commonwealth. They're going to get that information directly from Social Security, so we don't need to do that. We can submit Form 1099s for pension, annuity, or other retirement income. Another form that can also work is the Form W-2S, which I mentioned at the very bottom, has all the 1099-R information, so that can work as well. Federal or state income tax returns also have that same information. So what we're going to encourage is your site may have various kind of filing requirements to handle the property tax rent rebate. So your site coordinator will help walk through the process of what needs to be attached for the property tax rent rebate claim. So we'll have some income issues. For a homeowner, if you're a homeowner, you're going to get your rebate claim on the property tax. So one of the things we need to provide is proof that you actually paid your property tax. So this can be done in a couple different things. So you can get a copy of a receipted tax form, which generally means you've gone down to the property tax office and have asked for a receipted copy. They can pull up your records and actually stamp it to be a receipted tax copy that you have paid your income taxes. If you don't have a receipted copy, you can actually get a copy of your tax bill and show both sides of your check. So if you don't have a receipted copy and you somehow have a financial institution that keeps your check copies enough that you can go retrieve them, if you have front and back copies to show that the amount was paid and deposited, that would work as well. So if you're paying taxes and it's not through escrow, you have to either get a receipted copy or just a copy of your bill and copies of the canceled or the cash check. If you do pay your taxes through escrow, if you actually have a mortgage on your home, you can actually submit your mortgage statement that'll show the amount of taxes paid. That's perfectly acceptable as well. So either a form 1098, or if you get a detailed statement that shows your real estate taxes, that will be appropriate for your tax receipt. A couple other things we just want to mention here are for renters, there's actually a certificate that needs to be completed. It's a PA rent certificate, which has to be signed by the landlord. We can help prepare that form as much as possible. We cannot sign on behalf of the landlord, so they actually have to get that signed. A lot of times people may be coming in already with the form completed, which is nice because then we can actually help them get all their documents together and do everything but lick the envelope and put the stamp on it. They have to go do that themselves, but we can help put the rest of that information together. So the PA rent certificate is just something the landlord is going to certify that they actually were there on the premises. Now, what happens if someone's now newly eligible for the PA property tax rent rebate? So a couple issues we have with first-time filers, and this one I just love what the Commonwealth asks us to do. So if you're now 65 or older, so generally the first time you're turning 65, you're now eligible for the PA property tax rent rebate, and the government wants to give you the opportunity to apply, but you have to provide proof of age. So we have a list of documents that you can provide. Now, when you read the instructions, the government says they want copies only of the following documents. So the first one I'm going to mention to you is a birth certificate. If anyone's looked at your birth certificate, in bold, it says do not photocopy. The birth certificate is issued by Pennsylvania, right? A municipal subdivision of the Commonwealth of Pennsylvania. They're asking for a copy of their own document that they issued to you back photocopied after they just told you not to photocopy the document. So I'm not quite sure we have that little disconnect between the ones who issue and the ones that request it. But you are allowed to photocopy a birth certificate for this purpose, and apparently this purpose only. I guess it costs the printing office too much to say do not photocopy unless needed for proof of age for the PA property tax rent rebate claim. But that is one document you can photocopy and send for proof of age. Hospital birth records. If you still have an issue where you don't have a birth certificate, but you have that little slip that was given to your parents to say, congratulations, you have baby born on this date, that works. We highly suggest you get a birth certificate though, because you need one for real ID. And if you ever want a passport, you need an actual birth certificate. But the hospital birth records can count. Driver's license, a copy of that, a passport, your PA ID card. If you have a Medicare card or a PACE or a PaceNet card, that can also qualify for proof of age. So again, just a photocopy with the PA property tax rent rebate would suffice. If you're a widow, basically starting at age 50 up to age 64, and you wonder, well, why not a widow after age 64? Well, you don't need to worry about it because then you're over 65, so then you qualify under that category. But if you are a widow or widower between 50 and 64, you would need any of the age criteria, and in addition, you would also need a photocopy of your death certificate. Again, they really don't like death certificates photocopied either, but apparently the state just makes up its own rules when it comes to verifying age and death. If you're permanently disabled, again, so this would be individuals age 18 or older, we would need a Social Security Disability or SSI award letter. So we would need a copy of that. If you don't have an award letter and you're a veteran, you can provide a VA letter stating the disability, Or if you don't have either of those, you can actually come up with a physician statement, which is ironically called a PA 1000 PS, or physician statement, which would be completed by the physician indicating what your disability would be, and that you would be eligible for the PA property tax and rent rebate.